Okay, so what I'm going to talk about today is futures trading. Just a quick run through what futures are, um, some of the key concepts around them that people need to be aware of, a couple of little risk warnings around that with an example, and then basically how you trade them. And then I thought I'll just run through the last week of trading Nasdaq minis, just so you can see some of that stuff in action. Let me click on this screen. Right. So, what is a futures contract? They are contracts for delivery of a real world commodity. Specifically, they are sometimes in. You might find some of the sizing quite odd, and you wonder why they are as they are. You know, for instance, live cattle is 80, and barrels are 1,000 barrels for a full contract. Wheat is in sheafs of 40 and stuff. Essentially, they are what they are because that was fitted inside a standard railroad car for delivery to Chicago, where the CME actually is, and that's where all the full size contracts are based on. Um, they are designed as institutional instruments. They're vital to the real world economy. So all the things you'll find in futures contracts are really basic economic tools that people use. For instance, oil, that type of stuff. If you need oil, you're an airline or something, you need to buy oil or a refinery or whatever, then you buy that via futures contracts to lock in prices or to hedge prices and so on. Much the same as they were also designed to allow producers of the commodities a fair price on the market rather than necessarily when the harvest came in, then everything would be a glut of supply, and prices would drive down. So they were designed around that kind of stuff. Very important to know about a futures contract, and we'll get onto this shortly, but it's an obligation to deliver or take delivery at the designated place and time that's stated on the CME contracts page. It's not a right you can exercise optionally. If you're holding the contract and the contract expires, you have to take delivery of that. So if you get a full contract of oil, 1,000 barrels, you need to take delivery of that. If it happens to be WTI, something like that, or what's called light crude in the markets, then there's only one place in the world you can take delivery of that, and that is at a facility in Oklahoma. And that was the cause of one of the great big losses that I'll talk about later. Not mine, by the way, but someone else's. You have different sizes of contracts, the full size contracts, minis, and micros. The minis and micros tend to now have some of the most liquidity, especially in financial markets. And probably the one that's got more liquidity in the full size contracts is the Forex market. Price on contracts is calculated in some of them are ticks, but most of them are basis points, and a basis point is generally made up of a few number of ticks. I'll get to what that actually means in my next slide or two. And another key feature about markets is they are a 24-hour market in most, but not every future, but certainly the vast majority of them are 24-hour markets. Natural gas is one which isn't, whereas oil is, and stuff like that. So, what you have to be aware of is it's not the same as margin in stocks. You have stocks you're buying on margin is it's a down payment on the asset of the stocks, whereas a futures contract is regulated differently, but completely different regulators. And therefore, they have very different margin requirements, and what you're getting is pure leverage, and therefore your exposure to the market is much higher than it would be in you trading any kind of stock ever. That's probably both one of the upsides and one of the downsides, because as we all know, we can make many losses and few wins. In futures trading, you've got to be very careful that you use the leverage to magnify your wins and don't use it to magnify your losses, which is what I see a lot of people doing when they're buying stocks on margin. But it's a very different beast. There's two types of margin required. There's the maintenance margin, which is the one that's set by the exchange. So for opening a position of one of whichever type of contract, there is a margin that has to be lodged with the exchange. That's done on your behalf by your broker. Your broker will also require a separate set of margin, and normally that's to cover a minimum size or difference between your buy price and your stop loss, or your sell price and your stop loss. Hence, the brokerage margins fluctuate with price even during intraday. So I've got a worked example of that so you can see what that looks like. There are no pattern day trading rules, so it's extremely capital efficient. You can be trading micro Nasdaq for as little as $2,000, I think. So it's the extremely capital efficient, and with that $2,000 you'd be taking position sizes of about $30,000. There are no minimum tick rules, so shorting is extremely simple. You just either go long or short on a futures contract, and you can flip them around to your heart's content. And I say the leverage can be extremely high on some contracts, on some of the tier 1 forex contracts, i.e., GBP USD or Canadian dollar, US dollar, and stuff like that. They can be up to 400 times. So let's look at this is S&P futures. It should actually say Nasdaq futures. Because I was changing this from a previous slide, but if you ignore the S&P bit, but this is the Nasdaq futures. So a full size position is 200 of a Nasdaq stock. It's trading at I think about 17,500 today. So that's a $400,000 position. You'd be taking for one contract of that. The E-mini Nasdaq is a $20 position, or it's $20 per dollar. So that again, that would be somewhere around a $35,000 position you're taking on that, and the micros is a $2 position. What that relates to in margin size. So if I take the E-mini, which is the one I trade, so the margin required by the exchange is $17,700 per contract. So that's transferred by your broker to from your account, obviously. And then the I margin or the broker margin is $3,400. So that's the kind of margin that those E-minis are running on. It's settled. These are settled on quarterly expiration. So there's 4 particular contracts a year. There's the current contract, and then there's the next futures contract and so on. Most brokers allow you just to have a rolling contract, so they'll automatically roll over for you. Rollover fees, if you're in a contract and don't want to be taking delivery of said constituents of the Nasdaq, then you would roll it over, and it's normally about $1 a contract or something, the rollover fee, but you're better just using the brokers ones who do that automatically for their clients, and that's kind of baked into their spreads generally is how they pay for that. A tick is, as I said, this is how you can measure things, and it's sometimes called a basis point as well. You can call it either thing. Most of the financial institutions will talk about basis points. So in terms of this E-mini contract that I'm trading, it's a 1 point movement. So it's a $1 movement in the Nasdaq 100. That's worth £20 per E-mini contract, but the tick is actually at 0.25 index points. So, or 25 cents. So every 25 cents up or down, your contract is going up or down in value by $5. That's how that works. Trading on it is 23.75 hours a day, 5 days a week, blah, blah, blah. So where you get this information, I'm just going to flip to, okay, hold on, if I go here, escort for that. If you go into the CME webpage, it will tell you all the specs are, what your contract is, pricing, ticker codes, all that kind of stuff. You get a view of the daily volume that's going through, when all the clearing is and so on. And if you need to see your specifications of it, then you get all that stuff there with your settlement procedures and so on and so on. You can see what the margins are in terms of the exchange margins and the likes. So, and you can flip through any particular of their contracts. They've got plenty of them, and if you can look at the different asset classes, agro. Crypto's one that is interesting that they've got futures on, and we'll have a look at that shortly. Probably after the summer or something. So I'll go back to this. So, right, more about how these things actually work. All futures contracts are marked to market. What, if you've not used a mark to market account, means every day upon the settlement period, your account is adjusted either up or down by your profit or your loss, and that's taken directly from your account. That is why brokers and so on require separate margins. There is a settlement. It's for the contracts I change it, and probably you guys would trade in terms of financial. It's 3 p.m. Central Time, which is our Chicago time, which I think is Central, for margin calls. So at 3 p.m. they agree a closing price, if you like, for that contract for the day, because the market never actually really closes. There's not a close as there is in stocks, but they essentially declare that as a closing price, and that's when if you are requiring to lodge more margin before you're forcibly closed out of your position, that's when you will get the margin call shortly after 3 o'clock. You have until 3:30 to lodge that margin with your broker, and if you don't, you will be forcibly closed. And if you don't have enough money to meet a particularly large margin call, then you will be in breach contract and you will get sued appropriately. So you just have to be aware of that. So 3 p.m. is the witching hour. I was going to go over a lesson in ignorance and greed, but it's no laughing matter, but a couple of traders actually blew up their account and ended up owing, I think, $19 million to their broker, and they were found guilty and breach and all that kind of stuff. So they still owe that money. They've lost their home, everything, and so on. And I'll jump to TradingView to show you how that happened. Bring that in. Can you see the TradingView screen there, Mike?
Yep.
Excellent, right. So they were trading oil contracts, and this is during the height of COVID. Let me make that bigger. So they were trading these oil contracts throughout COVID, and it was in a pretty sustained downtrend. Now, one of the key things about futures contracts is futures trend really well. Those are the most trending things out there, and we can go through a few of them to look at that. But this day in particular, now this was the expiration of contract day. And some, if you like, newish type of traders, I don't know how new they were or what, but certainly inexperienced, saw the price of oil starting about $18 roughly that day, and it started coming down towards zero. They bought some, from memory, around about $10 a barrel, in the presumption that it was worth far more than that, because the actual oil price at the time was like $70 or $80 a barrel, something like that. So you could only see it going up. It got to $5 and they bought a bit more, and then it got down to $1. And they bet their life savings on it, basically. Now, what happened, as I've explained, there's an obligation to take delivery. So they've bought this oil, they now have to take delivery of it. and they got to take delivery of it at 3 p.m. that day. The problem is the facility in Oklahoma, which is the only place that you can deliver or take delivery of the oil, was absolutely full due to COVID. So there was no space in it, so nobody could take delivery. So essentially, all the people that were holding a lot of these contracts started dumping them off, essentially paying people to take delivery because they had nowhere to put it, or to pay the thing at the time. The rollover fee was about $20 towards the end of the day. So these poor guys had bought here on ridiculous margin, tens of thousands of barrels of oil. At this point, when it gets down near 3 o'clock, they had a couple of margin calls during the day. They managed to raise the cash, but at the end of the day, it got down so far, $40 down. They essentially lost everything and ended up on the expiration of the contract. They couldn't take delivery. They were therefore in breach of contract and got taken out of the market. So just have to be a little bit careful. And I suppose the message is that if you're trading in hard commodities at all, be aware they can go low, because this is all about taking delivery. And as I said, there's an obligation upon you to take delivery of that stuff. Let me go back up. Mark to market example, how does that actually work? And this is something you'll see in Livermore. If you read him, he was a big futures trader. But this is how they're so capital efficient. So for a given account, so I say I buy one contract of Nasdaq E-mini at a strike price of 18.70, say. My margin requirements are just over $20,000, as you see here, $21,000. So I now own 20 times the Nasdaq in terms of the amount of stock. So that value of that is £37,400, or dollars, I should say. When I decide to exit that contract, or even at the end of the day, if it was at 1950, the contract is now valued at $39,000, because 1950 to 1870 is 80 points times 20, etc. So what I would get is $1,600 transferred immediately to my account. Now, you can see that if you're in a long trending thing, every day, if the thing is going up and up, you're getting money transferred to your account by the equivalent of how much it's gone up times the size of your position. So, after 5 days, you have another $8,000 in your account if it goes up at a similar rate, and so on. So this is how you get more money to buy more contracts to leverage up that position without, losing any of your immediate capital. The alternative, of course, is that it goes down a bit. So, if you had a standard type stop loss of maybe 20 basis points or 25 basis points or so on, position would now be 37,000, so you would have $400 transferred from your account. And that's the sort of risk to reward I try and look for, is about 4 to 1. So you can see how efficient it is in terms of capital, but as long as you're taking good care about how you trade these things, then you see your account really just kind of growing. You shouldn't be having any too big losses. We're back to the basis points piece. So our basis point is $20 per point roughly, and so that's kind of how it's easy enough to work out how your 80 point move times 20, 1,600 quid. So a little bit on time zones. Not all futures are active in the same time zones. Most of the big ones are, but things like orange juice and all these types of stuff are very different. They tend to be very US based in terms of time zone. That can determine the personalities of the contracts. Settlement periods will differ between the various contracts as well. And one of the key things I do is trade the key opens and time zone ranges, which I'll show you just in a minute or two. Sort of 4 key trade techniques. there's a thing called they're slightly in the wrong order here, but the Asian range is the overnight range, really, that where the Asian traders are trading primarily out of Japan, Australia, and New Zealand, and so on. That's tends to be mostly gold, silver, precious metals, but also the financials, as you'll see, which we'll show you in just a second. London Ledge is a small gap, and what these do is essentially set up ranges that if it goes outside that range, that either long or short, then that's where you take the trade. London Ledge is 7 to 8 a.m. London time. It's very prevalent in oil, gas, and currencies, but it's also quite useful in financials markets as well, particularly the Nasdaq one, which is a lot more sensitive to it than the S&P E-mini. And then you got the pure price action type strategies, which is kind of what I use, which I'll take you through in a sec. And then there's some seasonality type trades that people often do in the softs, which are your orange juices and all that kind of stuff. Agro type things, soybeans, wheat, all these kind of things, or livestock, whether it's pork bellies or live cattle or any of that type of stuff. And they tend to be cyclical in nature, and longer term trades. So you buy them in the spring and you sell them in the autumn if it's a good harvest and things like that. So what I thought I would do, I know I'm taking a long time over this, is just quickly run through my let's go into here, Nasdaq trades. So I've been trading this for about 4 weeks now, but I thought I'd just go over the last trade, and there's some good examples here of what you'll see. Let me just I'll move my backstop up there. Unfortunately, no. Yeah, I've marked it in. That's all right. There's 3 lines on my chart. So this is the previous day, and if I zoom out, you'll see what it is. Essentially, these are previous days' highs and lows, and the mid-range of those days. So, and you'll see price action certainly within the Nasdaq, tends to bounce around between in those ranges, and when it goes outside of them, that's time for a trade. But you can also trade the price action around previous day's high, previous day's midpoint, or previous day's low, and they tend to respect those. There's a good example here. This is the Asian range. So you can see that is a fairly defined range. It's up until 7 a.m. GMT. And you could trade, normally you would say if when it breaks that range, then that's the direction you want to go in. You don't just trade any old break. You obviously look for a bit of price action around that, the high of that bar or something. And the low there, and you can see that if you trade that, you'd have had one loser, but then you'd have had a pretty big winner going on there. The London range is a bit tighter, so that's between 7 and 8 a.m. And again, you can basically extend this out, and then you would trade the breaks of that range. Obviously, looking for a suitable entry pattern or whatever, but you can see how that works reasonably well. Just trading the excursions from that, because it'll tend to try and come back to it. So that's kind of London Ledge. You'll see that a lot more predominantly, as I said, in the oil market, and that's like 8 o'clock. But that's where you measure it from. So I just thought I'd go back a week and just quickly whip through the trades that I did. Moving stops all over the place here. Friday. So if we kind of we'll go from Thursday. Don't know if there was anything on the previous Wednesday. Probably not. I don't think I traded anything that day. That would have been quite a good day. But again, you can see how as it breaks through this high of the previous day, then we set up some ranges that you could start to trade off, and then you would have got a nice upside. It's kind of setting the tone for the day. So it breaks through here. I'm going long today. That's your bias for that day. So this is an Asian range forming in here. As you can see, then we have the London range there. It was much the same, to be honest. As it came back down through the previous day's high, then there was obviously, and this is for your basic price action stuff, starts to come in. Let me just bring this up so you can see it. It pops down under that high. Then we look for possible entries to go short. We're looking for it to go down here at the first instance. We get in short. It goes down. It bounces. I've drawn this in later, but it goes down, bounces off, and eventually gets stopped out at break even on that point. Then it goes long. Probably wasn't looking at the charts much at this time. I think that was the only trade I took that day. Yep. So that was a kind of break-even day. And move over to the next day. Again, we'll see this is the low of the previous day. And we got into this quite early on as it came up over the low. We got this little indecision bar. It's easier to get when you're at the right-hand side of the chart, to be honest. I've often talked about these kind of power bars through resistance. And then the pause bar, so then we get into that and we buy into that trade. We then start looking at what's actually occurring in the market. So we've got a little mini uptrend there. We've got another higher low, then we've got another higher low. And normally when I put these higher lows in, that's where I'll put my stop. We get a higher high, another higher low, stops in there, and then 15 minutes later, so then we're taken out of that trade. Then we'll just watch what's happening in the markets. Again, we're looking for action around, or I'm looking for action around those previous points. Comes down, we get a slight uptrend, or at least a bottoming pattern there. So we start looking at, are we going to go back up to here? So take a trade on that as a nice tight stop in terms of this market. So 14-point stop or so. And then we get up. Then it sort of starts to stall, and as we get that stalling action of taking the previous low and got out just there, now we start to see this downtrend in action. Then we get a lower low. Then we get a lower high. Then we get a lower low, lower high, lower low. So we're starting to look for short. We've broken through this pattern here, this previous day's low at the bottom, so we're looking to go short on this lower low here. We get a spike down there. We obviously missed that, so we didn't get in there, but we take the next one that we can, which is on this little bar here. It pokes down, comes back up. I think my stop was probably there, to be honest. And then it starts going down and down, and we just again follow it down. We get this reversal pattern here, so we look to put our stop in at the high of this candle here, and then sure enough we get taken out on that. But then 2 candles later we see an entry, so we go back long because we're heading back up. So we just go long again, and up we go, and then we get this, if you were looking at the right hand side of this chart, what you'd see is a kind of lower low. It's starting to creep back up. We put our stop in there, and then sure enough we get taken out on that one, and that'll do us for the day. Next one is similar. Again, we get a reaction off this previous day's high. We've got a lower low there. When it breaks that low, we go short. We don't get great action, to be honest. It doesn't move that far. It's probably a light 25-point move on the Nasdaq. It's not particularly huge. As we come up, we start again. If you're looking at this on the right hand side of the chart, you see it starting to fall off. So that's where I'll be putting my stop at that lower high, and then we get a reversal bar, takes us out. Reevaluate as we come up through this. We get these power bars and pause again. So let's go long, and then we just follow that up, and we're marking higher highs or highs and lows, swing highs and swing lows, I guess, if you like to say it that way. We get one there, and eventually we get taken out on that one there. So we've got a nice kind of move on that, and I think we left it alone for the day. Moving on, much the same sort of, just kind of repeating this sort of pattern. I didn't find anything yesterday at all, but I was distracted during the day quite a lot. And then today, we're looking at these two ranges here. They're both sitting around the previous day's high, so we know that this is a key point. We get a reversal down here, power bar, pause. Let's get in. Aiming to get to this high, see if it goes through. It doesn't go through. It bounces back off it, so we take that trade out there. And sure enough, it does eventually go back through. We're looking for reactions around this line because we've got a higher high, then we've got a higher low, but all of a sudden we get lower highs, lower lows, lower highs. So we're going to go short when it busts through here. A nice opportunity, tight stop. Let's see if it's going to go short. We're looking to get it down here. And got a really nice move at the end of today, so that that popped down there, and I think I got about 10-1 on this one. 91. So 1800. I'm only trading single contracts on this. 91 for an 8-point risk. So 10-11-1 risk reward. And that one, and again, you can see how I was moving my stops up. That stop was up there. Bit of slippage on that one, but that's futures trading. I've gone through it very quickly, so I'm more than happy to ask any questions. No questions, so that's good.
Whoops. I was on mute. Might help to unmute yourself to ask questions. No, I was going to say, excellent presentation, per usual. A question that I have is that, so you're trading just Nasdaq E-minis, is that right?
Yeah, that's all. Yeah. I have traded other things in the past, and I did say I would look at how trending these stocks are. I need to take these indicators off. But you can see it. Well, Nasdaq trends quite well, but if you look at something like soybeans or any of that stuff, you'll see that the if you can get in on a trend is what kind of black hole going fishing a little bit. But when you're trading these sort of markets, and you get a reaction, for instance, off that day's low, and you go short on it, then you're into that trend. It just depends on your risk appetite, how long you can stay in it, or that one there. I mean, that trend lasted 4 months. Gold's very similar, and you got a trend there. The last months and months. A lot of them. This is the Bitcoin futures that I was talking about. Again, it seems quite trendy in terms of the futures. Silver is another one. I mean, they're in these rangy markets that are hard to trade, but and then you got your crudes as well. Crude's very volatile. It's quite but it's a highly traded but volatile market. And then gas as well. It's been volatile over the past, but you can see how if you can get in on one of those trends, which is the kind of Livermore trick, which is why I've been reading them again, really, is if you get in at the see on this downtrend, you short in there, and all you're doing all the way down here is just picking up lots of money, and you're getting it daily, every single day. So it's that's how you build those biggish accounts, and you can see it's about finding those trends. But once you can trade one futures market, you can trade any of them really, because the same rules more or less apply. If I go back to, I mean, I've been just trading this on the 5-minute, obviously, but turn my put my stuff back on. But yeah, so, but for anybody that wants to give it a go, I mean, you can certainly just open a futures account with one of the regulated brokers, and you can trade the Nasdaq E-mini for, as I say, for a $2 contract for the micro, which is quite a liquid market. And that'll give you good practice. But what it is good practice at reading charts, figuring out price action, and all that. What you don't have to worry about is there's no real. You're not looking at fundamentals. You're not doing any stock scans or any of that type of stuff. So, which is why I'm, just going to be trading futures over the summer while I'm traveling about. So you can just pick it up and make a trade and then duck out again.
You don't have to worry about barrels being delivered to your front door.
No, because I trade the rolling contract, I must admit. But when you go in, you can most people will trade the current month until the last 4 or 5 days, then they move to the front month. After that kind of thing, and they'll start moving it over. But trade a rolling contract, don't worry about it. But it's not something you need to pour a lot of money into, and as I say, it's very, very capital efficient if it's just pure trading that you want to do rather than any sort of investment type stuff. I hope that was helpful.
Are there any tactics that are translatable between stocks and futures? I guess like the technical tactics or
yeah, what
somewhere in that realm.
No, I think you're right. What you'll get very used to is looking at that right hand edge of the chart all the time, and picking up some of the character of various moves that are made. Most future trading is done around support levels, support and resistance. And it's that's the kind of key to it, as far as I can see. People that are, and it's maybe going back to the old pit trading style, open outcry type stuff and all that, because that was very much how they traded, and I think a lot of the character on that is still much the same. And it's taking advantage of some of those fluctuations within the market. But if you could, I had one 3 or 4 weeks ago where I got into a move, and I was only expecting it to move about 40 basis points or so. I actually went down nearly 700, and I was just by playing the market, waiting on that big move, and it just went on and on and on and on and on, and it was somewhere in the region of a 60-to-1 risk reward type shot. So again, from a capital point of view, it was really, really efficient in terms of that. But and it's maybe more about trading on your wits as well, a little bit, Mike. Particularly on the 5-minute chart, but you could go to a 15 or something. But it depends whether that risks. The price action is much the same, to be honest. It's maybe a bit less defined on a 15-minute, or you could trade them on dailies if you want. But I think that'd be. You need deeper pockets to trade them on the dailies, because look at the size of the ranges.
I have a trading psychology related question for you now. What's it? Tell us about what's going through your mind on that 60R trade, throughout the life cycle of it, right? Because a lot of people find, and myself included, would be like, wow, that I want to give this room to run. I'm up, I don't know, say 20R, 30R. I don't want to give back this much, but how do you? What's going through your mind? Walk us through a little bit if you can.
yeah, it's like you just. I mean, it's a bit like this one. All of a sudden, you get into a trade and the bars get bigger and wider. So you know, I mean, I wasn't even looking at the screen when this bar occurred, but that's 70 basis points. That bar. So that's a big, big bar because I don't had an 11-point stop loss on. So, but what I'm just focusing on where as it's coming down here, and this one popped down here. I'm really just looking at going, right. That's the point. If it comes back above that, I'm out. Kind of thing, and then it pops down there, and then you go, well, okay, we've got another, and then just following it down, all the while looking for those higher highs and higher lows, because you can see there that there's your, if you follow the action, you get your high, then a low, then a lower high, lower low, lower high, lower low. Oops, if I can get that drawn in. And that's all I'm doing. It's just looking at where's the support and where's the resistance, lower high, lower low, and then just moving my backstop down, which got these two bars here, up, down, reversal. So an up bar and down bar, the reversal at the downside. So and then we pop down lower. So I'm just watching that, and then if it goes back up above this, then I'm out. So that's all really. But as I say, that they do tend to when you get that catch one of these trends, they tend to go when it's multi-day. Then I need to go back and find it. But at the end of the day, this here is we're at the end of the day. In another half hour, this is going to flatten out and calm right down. You can see it. So if you were in this long from down here, you come up here. There's nowhere really that you've taken it. There's your lower low, higher low. There's your higher high, higher low, higher high, higher low, higher high. All the way up, and then you get into this bit here, and then it just flattens out. So you can hold that overnight because it's you put your stop down here and just leave it. Wake up in the morning and hold on a wee sec. So my wife was shouting on me there for something. So yeah, that's all I'm doing is just watching it. But it's also kind of knowing what. Again, it's knowing your time ranges and so on as well, Mike. But everyone's got its own character, and that after 10 o'clock, which is 15 minutes time, things are just going to flatten right out here on this one.
It sounds like you're very much focused on process and not really thinking too much about, I'm up this amount or I have this number of R while the trade is going. Is that right, or am I?
You're absolutely right, because I don't have my brokerage account, which is on my phone, up and running while I'm watching a chart. So I'm just reading the chart. I'm not seeing. I don't have it linked or anything like that. So I'm not actually seeing any profit and loss numbers flashing up or down. There was a time when I used to use brokers' charts, and that was always quite off-putting to watch. Because when there's a massive spike there, look at that.
How quick does it move? So you see it on your phone, and the reversal's happening. Okay, time to get out. Do you have how much time do you how much slippage is there between you switching apps to get into your broker to say, okay, let me sell?
I'm not. Yeah, I'm not. Yeah, I'm not. It's not instantaneous or anything like that. I'm not trying to get out straight away. And like an exit of this, that's like 15 minutes later after I've placed that, just moved that stop. So I just go into my app, move the stop to whatever the 18,712 I think it would taking me out at, and if it gets taken out, it's taken out. So, much the same with all of these. This level here was plugged in 10 or 15 minutes before. So it's not trading tick by tick or anything, Mike. It's just it's just those major levels. But that's why sometimes previous days, you're not making much at all. You've spent a while doing this and that. I think when that short there didn't make much at all. 10 points, $200. You might say, is it really worth it? Well, probably not, but that could have kept on going and going and going. Again, you'll see there's the level. Stop was in, stop was moved down. 5, 10, 20 minutes later, it gets hit. So much the same with this one. I mean, that was about an hour later, isn't it? 2, 3, 4, 7, 8, 9, 10. Yeah, about an hour. But normally once I've made that sort of 4-to-1, then tend to relax a bit more with it. To be quite honest, because I'm happy with a 4-to-1 ratio. It keeps me profitable.
Yeah, I'm sure. Keep most of us profitable.
Certainly encourage anybody that's even just to hone your skills a little bit. Sometimes it might be worth just putting 4 or 5K into a futures account and trade the micros. See how you get on. You'll learn a lot, if nothing else.
Yeah, that sounds that way for sure.
But the other thing, if you don't need any indicators trading futures, they're pretty useless, to be honest. It's pretty much all horizontal support and resistance, which anybody can draw with a line.
Those are the questions that I had for now. Now, any questions, Joe, Tish?
Not for me.
No questions for me. It's a little over my head, to be honest with you.
thought sent everybody to sleep there. Yeah.
Well, the report
But yeah,
will be available.
it can be a bit scary, the whole contract size and all that type of stuff. But ultimately, what you need to know is that you're buying. If you think of it like stocks, like Nasdaq here at 18,803, you're essentially buying one stock of that, and it costs you 18,803 to buy. Although you didn't have to pay all that for it. Your margin requirement is about 4,000 or something. So that's essentially your position is that, and as that ticks up or down, then it's going up or down by whatever size contract you have. But yeah, it's a good example, and it might be something we can do as a joint thing, Mike. Sometime in the autumn, look at the Bitcoin market or something like that. Happy to do that as well.
Sure.
I think it seems a very efficient way of trading Bitcoin, because the margins on it are quite small. It's for a full size contract, which is 1 Bitcoin. Margins on it is, I think, about 8,000, something like that.
Very interesting. Yeah, we'll think to talk about that when you're back.
Yep. Okay, I'll stop my screen share.
All right.
I was just kind of hoping that we'd pull all that price actiony type stuff we've been talking about together and all that kind of thing. Stop streaming. There we go.
All right, wonderful. Well, thank you very much, Stu. That was very enlightening, and yeah, I think that we'll add it to the video library, and it'll be one where we'll probably want to watch this video a few times.
Okay. Yeah, and just reach out to me. Anybody that wants me to go over things in a bit more detail or whatever, happy to do so.
Yeah, absolutely. All right, Stu, everyone, thanks so much for being here. Appreciate it. Appreciate you all. And
Thank you.
we'll see you next time.
Okay. Thanks, folks.
Bye.
Bye.